Good morning, guys, and welcome to the weekly webinar series. And I'm really excited to bring on today's guest, Lon Welsh. He's the founder of Ironton Capital. He was a previous guest on the show in a sponsored episode. And today he's going to talk to us all about the national real estate trends. And I'm really happy to have him on. Lon, welcome.
It's great to be here. Thanks for having me back.
Yeah, take it away. I think the audience is really excited to hear your presentation.
Great, and feel free to jump in with questions at any point in time if you want me to elaborate on anything. So, I do a national trends update once a month, and I've got way too many slides for our 20 minutes today. So I'm going to take my usual presentation that I do, and I'm just going to show you a part of it, and then each month we'll do a different part, and that way we won't be too overwhelming. And for the listeners who want to learn a little bit about passive real estate investing, which is what I do, you can go to irontoncapital.com/financial freedom and get a copy of our book for free. So what I thought I'd talk about today is what's going on in the apartment market currently and what's going to happen next. And this will do a lot to inform you guys about the commercial real estate investment world right now. So the first thing to know is that the U.S. is structurally short of housing. There's been several different research institutes that have looked into just how short of housing are we, but the estimates are usually somewhere between 1 and 5 million housing units for both purchase and for rent that we're short. If you take a look at the inventory of housing units we have in America, adjusted for population, you can see that we're just about the worst among these large countries. Um, there's a huge chronic undershortage. So you're going to probably see the real estate market for purchase homes continue to do reasonably well on the long haul, although I expect it's going to be a little bit choppy over the next 12 to 18 months. And over the long haul, the demand for rental properties will be strong, although in any given moment in time, there'll be a little choppiness. And we're going to mainly talk about that today. One question I'm frequently asked when I speak about this is there a lot of office buildings going to be converted into apartments, and will that glut the market and really make it less attractive to be an apartment landowner? And the answer is probably not. If you take a look at where most of these conversions are at, they're in New York and Washington, D.C. and Los Angeles, and it falls off really quickly after that. But the total number of office to apartment conversion units relative to the embedded base across the US is so small, it's well under 1%. So while this is a very interesting trend for us to talk about on the national news, it's not going to move the dial at all. Draining some of these office buildings out of the market will support the office market, though, and it's very exciting for the people on the office side. So, what's been happening with prices for apartment buildings? Well, the answer is that they're off about 20% from the peak. You might remember that during COVID, we flooded the market. The Federal Reserve made it very, very easy to borrow money for very cheap rates. That stimulated a huge spike in demand. So if you take a look at the orange line, which is the price of apartments, and this is indexed to 2007, you can see that there's a huge run up in the prices. And then as soon as the cheap money dried up in early, like April of 2022, the price started to go down. So we've had about a 20% correction. I think we've probably had all the correction we're going to have on this. And you can see actually that it looks like we hit bottom about 2 quarters ago, and apartment prices have stabilized. They're going up an itty bitty tiny bit. For reference, if you take a look at the great financial crisis of 2008, 9, and 10, apartment values dropped about 30%, a little bit less than the other categories of commercial real estate. So that's probably it for the correction on this cycle. If you're waiting for the bottom, we're here and we're past it. So what's going to happen next? This is sort of the summary of what I want to talk about for today, and we'll have a couple slides for each of these bullet points. So there was a huge addition of new apartment capacity delivered in 2024. But despite that, we still saw rents go up a small amount, which was a huge victory. We were all expecting rents to go down last year. It did vary by region. So the Midwest, which had the smallest amount of construction relative to population, very healthy rent growth, about 3%. The South, which had the most new apartments relative to the population, saw prices erode by about a point. But given how much was going on in the market, that's fantastic. We anticipate that 26 and 27 rent growth are going to be stronger because the number of new deliveries coming into the marketplace is going to be a lot less. And I'm going to talk a lot about that today. So, two economist groups that are really great to follow if you're interested in the apartment industry are RealPage and CoStar. They're within a rounding error of each other for what they expect to see for rent appreciation in the next 2 years. So, one thing that has been a challenge is that there was so much new capacity delivered at the same time, generally in very, very similar neighborhoods, that the competition for these new buildings to lease up is a lot more intense than it historically has been. So currently, it's taking about 16 months to lease up a brand new building when historically it'd be about 12. So for those of you guys who are invested in projects where they've delivered a new building, you should expect it'll take a little longer in that ramp up phase than you would ordinarily sort of see. Concessions, this is where the owner will give something to the tenant as an inducement to come to my apartment building instead of the new apartment building across the street from me. So maybe I'll give you 2 months of free rent, or I'm going to give you a $500 Amazon gift card, or something like that. So the concessions, as you might anticipate, are up because of all this new supply, but not as much of an increase as prior bear markets. And I think that's partially due to strong demand, which is really the key headline here that people don't know about. And just we're getting better and better at managing these buildings as they come online. So the other part of the teeter-totter is the property managers are offering much more attractive inducements to a tenant already in the building when it's time for a lease renewal than they ordinarily would, and that's kept the turnover to historically pretty low on the range of values. So if you look at pre-COVID, you'd expect that only 47% of tenants would renew on a lease, and now it's 55%. And I think the building owners have gotten smart. If that tenant moves out, you've got to pay to clean it, maybe repaint it, be vacant for a while and eat that loss. And then the new guy coming in, you're going to give him 2 months free rent as concessions to get him in the door. Why don't we just offer this existing tenant 1 month of free rent and then they don't have to move and we can all win? And I think that's been a very smart strategy across the entire industry. Here's a Freddie Mac estimate. Their estimates that we're undersupplied by almost 4 million housing units, and nothing's going to change about that anytime soon. So the biggest great thing that enabled the stellar performance that we had last year was demand. So for whatever reason in the commercial space, we call this absorption. So we had about 700,000 units of absorption in 2024, the second best number of all time, and the best number we've had in the last 25 years. So we had all these tenants who decided, I want to get a place to live, and I'm going to go rent in a new building. And it's just absolutely incredible how well this all worked out. Look and compare the deal that we've got here in 2024, this massive absorption number, compared to 2022 when we lost. So you remember we had a small sort of a hiccup with the economy in 2022, and some people lost their jobs. And what they may have done is decide to move back in with their parents, or maybe they moved in with a friend. But the number of people asking for a new rental unit was negative. So there were fewer renters at the end of 22 than there were at the beginning of 22. Exact opposite in 24. So basically what happened in 24 is all those people that we would have normally have had in 24 and 23, we got all of them in 24. So it was just an incredible year for demand. So that's the demand side. Let's talk about the supply side. So you can see in 2024, we had a gangbuster year for new deliveries. And the reason for this is that the apartment market was really strong in 2019 and 2020. And if you remember when COVID really got to be out of hand, like in April and May of 2020, the Federal Reserve slashed the interest rates, flooded the money supply everywhere. And since the rates were really low, the attractiveness of the economics for a developer to put up a new apartment building became very attractive. The banks were very eager to lend, so a disproportionately high number of new apartment buildings got approved in the second quarter of 2020 through the end of 2021, about a 21-month period. And it takes about 2.5 years from the time that you get that loan to actually getting the building in the ground, getting it constructed, getting the certificate of occupancy, and then you're ready to start leasing up these new units. So the huge supply spike took place in 24. You can see 25 is going to be a strong year for deliveries, but not nearly as bad. And then it falls off a cliff. Why is that? Well, what happened is the Fed had to stimulate the economy from the middle of 2020 through the end of the first quarter of 22, and then they started raising the interest rates very, very rapidly. And all these projects that would have penciled at a cheap interest rate didn't make any sense at a higher interest rate. Also, the banks being worried about office space and having a lot of bad office loans, the banks hit the brakes saying, "Look, we're not interested in doing any more loans, and we're sure not going to speculate on a new building right now." And you can see that the number of deliveries in 26, these would have been loans approved in 22 or 23, is going to be less than half of what we had in 24. So for the next couple of years, we accurately know what the new supply being added will be, because if you aren't building it actively today, you're sure not going to be delivering in 26. There's just not enough time to build the building. So we're going to see some massive rent growth starting in about 18 months. And I should probably just pause here for a second and see, is there any questions about what I've gone through so far? Nope.
Right, right. I really love the analysis, and so continue on. I think towards the end we'll have more global macro questions, but keep going.
Okay, cool. I'll go for like another 10 minutes here and then we'll do that. So supply and demand are going to probably come into balance this year. This incredible rate of demand, so either for rent. And what's happened recently is that the job market has been very strong up until like the last couple of months. Even then, is when the job market is strong historically with new households. The largest driver of household formation is young adults who finally get a job and they're able to move out from their parents' house and get their own place, or if you go from one house apartment to find a place to live, and that creates one unit of apartment demand. So you can see the amount of new household formation in the last couple of years here has been well above translated to a lot of first-time home buyer purchases, and it's almost all been directed towards the rental market. So that's the real big driver what's been happening here. Will it continue? And the answer is probably yes. So if you take a look at the number of young adults in the 25 to 34 age bracket who are still living in the basement of their parents' house, you can see it's about 16% of them. Historically speaking, it should be closer to 12. So the last couple of years, we've been chipping away at the number of young adults living with their parents as they all move into apartment buildings, but there's still quite a lot more than you'd anticipate. So if we got to the historical levels, it's almost like a million more incremental units of rental demand that we could create. Just to give you a context on that, last year was the best year of rental demand we've ever had at 700,000 units. So the amount of new renter demand on the sidelines in the parents' basement is still very, very large. The other thing that's driving this is that there's a trend towards smaller average household size. In the past, kids would live with their parents until they got married. It was very common for people to want to live together if they were friends. And the trend just socially has been, I want my own place. I don't want to share. And that, of course, has been a huge driver of the overall apartment industry. So, what enables a kid to get out of the basement is getting a job. Wage growth has been really, really strong, and that strong wage growth is the other key enabler of getting a lot of new people out there to to rent properties. So really quickly, we talked about how concessions are lower now than they have been in the past couple cycles, and this is something I've not ever seen discussed in the media. But when I saw this chart, I was like, I've got to share this. So if you rewind to 2002 to 6, typically about 41% of landlords were giving some kind of a concession to fill a vacant unit. And if you take a look in the 2009 to 18 period, it dropped from 41% to 28%. And in this current cycle, we're only at 15%. So the concessions that are being offered are very targeted, very much in the new builds. Or if you've got like a 5 year old building across the street from a new build, you're probably doing concessions. But generally speaking, no one else is. So the landlord financials are much stronger than you'd anticipate given the incredible amount of new supply being added. So, um, We know the number of starts that we've got already. What's going to happen to starts going forward? And the answer is that there's no signs of any rebound in apartment building starts. So the leading indicators I like to look at are permits, surveys of developers asking what their plans are for the next 36 months. Architectural billing is really, really important. You might have someone who's got a piece of land under contract that would be appropriate for building an apartment building, and the first step in the process would be an architectural study to figure out, well, how big of the building will the zoning allow before you do anything else in that. Credit conditions, it's getting a little bit easier to get apartment development loans, but it's still not friendly by any means. And as you guys all know, interest rates have not come down at all. So cumulatively, if you evaluate all these things, I don't think that starts are going to get a whole lot better anytime soon. So what's the takeaway? The message I want you to leave this with is that we delivered a huge number of apartments. We filled them all up. We're going to deliver fewer new apartments this year. All the drivers appear like we're going to have good demand to fill them up as well. And the number of new deliveries is going to fall off a cliff starting in 26 and 27. And then if looking at what is likely for 28 and 29, I don't see a whole lot of evidence there's going to be a lot of new supply coming anytime soon. Even if we have a recession sometime in the next 2 years, it's probably going to be mild. It'll dampen demand a little bit, but overall demand should be very strong because of all these young adults still trapped in their parents' basement. This should set up a really strong bull market for landlords. There'll be too much demand, not enough new supply, which means the vacancy rates will be small, which means we can raise up the rents. So that's the main thing I wanted to talk about today. One quick ancillary thing is, what about distressed commercial properties? Aren't we going to see a bunch of commercial property foreclosures flooding the market? And the answer is, it's not happened yet. I do think it's going to increase a little, but not a lot. So if you take a look at multifamily, which I highlighted for you in pink, you can see that we're floating in the 3 to 5% of the mortgages on multifamily are in delinquent. They're more than 30 days late. So it's less than the overall commercial average, which is exactly what you'd expect. Historically speaking, multifamily has slightly lower returns than the other facets of commercial real estate, but it also has the least volatility, and apartments do the best in tough markets. So that's the reason why I see this. You can compare and contrast that to office, for example, where it's almost 3 times as many things that are distressed there. And one other thing we should talk about is what's the back door. Normally what happens is someone rents a place for a while and they save up down payment and they go buy a house. As you guys probably have seen, home prices and condo prices went up quite a lot over the last decade. The interest rates are very terrible. So if you take a look at affordability for a first-time buyer, this chart shows you the lower the graph, the less affordable it is to buy. And we're just about at the worst that we've been at since 2006. The higher the chart, the easier it is to afford to buy. So it's a very hostile environment for first time buyers. So they'll be trapped in these rentals for longer than you'd expect. Do you think these renters will be able to save up money for their down payment? And the answer is there's a lot of headwinds to this. Consumer debt in composite is at an all-time high by quite a record amount. I mean, if you just go back 21 years, we've gone from 7 trillion of consumer debt to 18 trillion of consumer debt. It's more than doubled. Some of that is student loans, but most of it is other types of debt like mortgages and HELOCs and cars and credit card statements like that. So I think that is the main thing I wanted to talk about for today.
Yeah, really interesting. And so,
I'm going to put this on here so I can see you as well.
yeah,
Well, I'll stop
yeah, and
sharing that
really,
if I can figure out how to do that.
yeah, really interesting. And so, one thing we have is the which when you mention these trends, which parts of the America and United States are these particularly strong, and which ones are? Is it any location or geographical trends or differences?
Yeah, we've seen there's been a lot more construction in the South, in the Southwest, and the West. So those markets are a little softer for owners of apartment buildings than, say, the Midwest, where no one's really building stuff in Ohio or Iowa for whatever set of reasons. Although they're not exciting markets, but they're nice and stable, and there's not a lot of drama. And sometimes no drama is a good investment.
Yeah. And so kind of, I know you're gonna come back on later. And what is the impact of Trump tariffs, inflation, interest rates, on, how do you see it playing out, either short term or long term?
Yeah, let me show you a really great little chart on exactly that. That'll help to illustrate this for us. So I'm going to go back over to, can you see my slides here? Can you see the tariff slide?
Yeah. Uh-huh. We can see it.
Perfect. So this chart will show you why the tariffs are going to be disruptive to the overall economy, I'm sure, but they're not going to have a big impact on new home or new apartment construction. So the x-axis along the bottom is what percentage of this item is imported versus made domestically. So if you take a look in the lower right where I've got the red circle, you see major household appliances. 70% of household appliances are made in America, 30% are imported from Korea or Germany or China. So that's the x-axis. The y-axis going up and down is how expensive is this product relative to the overall price of a new house. So if you look in the upper left, you see ready mix concrete. I circled that in green for you. That comprises about 6% of the price of a new house, building the foundation and the driveway and the sidewalks. So what you really want to focus on is things that are largely imported and are a large part of the overall residential mix of construction. That would be the upper right corner. And you can see, good news for us, it's almost zero. Um, the best case scenario would be the lower left-hand corner. So that means that almost none of them are imported. It's all made here locally. And it's a relatively low part of the overall home price. So I circled for you in green, paint and coating or asphalt paving. These are examples of things that are almost entirely made in America. Almost none of it's imported. So you can have as high a tariff as you want. It's not going to change that part of the home price budget. So the vast majority of the items that go into a new house are actually made locally. That's mostly because they're really heavy and they're very hard to ship. I think that's the biggest part of it. I think the biggest import overall, and a lot of that comes from Canada, although we certainly make lots of lumber in the United States as well. Price of tariffs.
Yeah. Interesting. And so, if if it's there's first time listeners or viewers on the webinar, how can they contact you, connect with you, and learn more about the offerings that you have?
Yeah, what you can do is go to irontoncapitals.com/, financial freedom, I believe it is. I'll just put this on the slide here for a second so you guys can see it. Yeah, irontoncapitals.com/financial freedom. Download a copy of our book on passive investing for free. And there's also a tool on there where you could set up a meeting with me or one of my colleagues if you'd like to talk a little bit about investing passively in apartments or anything else for commercial real
Excellent.
estate. And I'll share a copy of these slides with you, Dr. Lou, so you can share that out with your listeners as well.
Yeah. Excellent. And thanks so much for a great presentation. And we look forward to hearing you on the next series.
That sounds fantastic. Thank you so much for having me.